First of all, thank you so much, everyone, for being here today. It is absolutely fantastic to see you all, and everyone at home as well. Thank you for joining online. Sorry, the camera's over here. Thank you, everyone, for joining online as well. It's absolutely fantastic to see you all this evening, and thank you for taking the time out of your busy schedule to be here. We're so excited. It's been a long time coming for this event. As you can appreciate, with everything that's going on in the world at this moment in time, it's been really difficult to do face-to-face events. And trust me, this is the first of many to come. So please, please, please keep connected with us and look out for future events as well. Now, first of all, a couple of introductions. My name is Jo and I'm a financial advisor at Morrinson Wealth. And we're a principal partner practice of St James's Place. And then we've also got my colleague Vass, who's at the back there. Give us a wave, Vass.
Hi.
For those at home, you'll see Vass in a second come onto the screen. She's just getting set up. Vass is our protection specialist. And we're going to be presenting today. Now, before I get started, I want you guys to do a little bit of work for me. I'm sorry, I know you probably had busy days today. But please can you stand up if you've got children in the room? And those at home, can you put on chatter if you've got children, please? Just make a little note. Don't be shy. Okay, stay stood up or stand up or put a note in the chatter at home if you are self-employed. Stand up or put a note in chatter if you live in central London. Who was disappointed? Somebody went, oh.
Me.
Thank you very much. Sit down. And thank you those at home for joining in as well. You're probably thinking, why on earth am I talking about this? We're here to talk about women and their finances. Please, are you here for me tonight? Please join in. Just take a seat when you're ready. And it's more than welcome to have yourself drinks at the back as well. So why am I getting you to stand up and play a silly game? Well, the point is we are all different. We all have different situations, different circumstances. And all of these things affect our financial well-being. Our age, our demographics, our family structure, where we live. All these things impact our financial well-being. What also impacts our financial well-being is our gender. Men will face certain challenges when it comes to their finances, and women will face other challenges. But the honest truth is we're not talking about women's finances enough. Women's wealth is outpacing global wealth, yet we remain the most underserved segment in the financial sector. On top of that, women are half as likely to seek financial advice as men. We simply need to talk about this more, and that's exactly what tonight is all about. Wrong screen. I'm used to a clicker. So, why are we here? Broadly speaking, there are four main gaps when it comes to the challenges that women face. First of all, women are retiring with significantly lower pension pots than men. As well as that, we feel less prepared for retirement. I met a lady the other day. Unfortunately, she had to retire early because of ill health. She's in her early 50s. She's not able to go back to work. Now, she's with her partner, and he manages her finances for her. He told her to move her pension into a particular provider. He picked the funds for her, about 18 different funds. To be honest, I don't really know what he was doing. It didn't make any sense. And she now is breaking up with him, and she has no idea what she's investing in, what to do with the pot, and she needs to start taking from that pot in a couple of years' time. And she just feels like she has no control over this. She shouldn't be put in that position. She should absolutely have control of that pension pot that she's worked 30 plus years to save up for. And that's exactly what we're going to help her with. And she's not alone in feeling underprepared. We also need more money in retirement as well, and we're going to go on to the reasons why later on in this presentation. And then finally, something you guys have probably all heard about previously, the gender pay gap. And Vass, I believe you've got a personal story when it comes to the gender pay gap.
I do. Hopefully I can make this work. Can everyone hear me? Welcome, ladies. Hi, for everyone at home. Thank you for joining us. I'm Vass. I'm the protection advisor of Morrison's Wealth, and I wasn't wrong with the introduction because my mic wasn't working. Hopefully you can hear me okay, though. How many of you, by show of hands, at home as well, feel a little bit anxious and scared when an airplane takes off and it starts shaking a little bit, right? So 17 years ago, on my first flight to the UK. On my own, very young, very, very young. I was so scared. I was traveling for the first time to a different country altogether, leaving behind my family, my friends, everything I knew. A very a very good education I left behind to come to England. And I was excited for the prospect, but also so scared to be coming here on my own. And we had an airplane. So next to me sits Ben. I thought I saw Ben previously. I thought I saw Ben when the recruitment company who has recruited for the role I was going to have in the UK was recruiting in my hometown. I thought I saw him. But we have applied for the same job and we now got the same job in the same place. So I was so relieved to have a familiar face. And he's been so helpful. Ben, if you're there, thank you. He's been so helpful throughout my time together working with him. Now, a few months later, working in a kitchen of a restaurant, chopping onions with Ben, Ben told me that he was paid £8 per hour for the same job I was paid £5 per hour. Well, I didn't know. I didn't know that that's the going pay. But now I knew. Question is, now that I knew, did I do something about it? Did I do anything about it? No, I didn't. I was scared. I was on my own. I was thinking, what if I go and ask for a pay rise and they would say I'm not good enough, or maybe they send me back home, or maybe it's better for me not to say anything. Now, I knew and I didn't do anything about it. So knowledge is not power. Knowledge combined with action is power. So for the next 7 years, I did nothing. I stayed on the same pay. And I was always thinking of the wrong question. The wrong question. Who am I to deserve more? But the right question is, who am I not to? So if it's one thing I would say to my younger self, is get knowledgeable about what is the fair pay for that job and go and ask for it. Have the courage to go and ask for it. So thank you, Joe.
All right, thank you, Matt. But the important thing and why we're here today is it's not too late to start taking control. And yes, we're going to be talking about some of these gaps and some of these challenges that we face, but really importantly, it's about starting to talk about the solutions. And we absolutely can start taking control of these situations. So please turn to the person next to you. If you haven't met them before, say hello, exchange names, pleasantries and so on. But tell them, what would you tell your younger self? And those at home as well, please put your notes in the chat function. You're more than welcome to. Thank you, ladies. Sorry to cut the conversation short, but I hope you had a chance after the pleasantries. I hope you managed to talk to each other about what you would tell your younger self. Now, anyone open to sharing what they just discussed?
I like to what I tell my daughter every day, YOLO.
Love it, love it. Great words of wisdom. Anyone else?
I've never really understood money and finance. I should have paid better attention in those classes, business classes, and then taken action personally.
Did you have any opportunities growing up to learn about these things? Do you know? No.
I mean, at university, yes, I did a business degree, but I hated finance.
Yeah.
And it was mostly guys in those classes that were excelling, and the
Yeah.
women were not there. So it was scary, and it's intimidating.
Absolutely. Anyone feel like they've been in a similar position? I didn't know half of this stuff before becoming a financial advisor, well, any of this stuff before becoming a financial advisor, and you're definitely not alone, Marcella. Anyone else open to sharing? Or anyone at home? Anything in the chat function?
Why Apple chairs?
Yeah, love it. Why not? Do you work at Apple by any chance? Brilliant. Thank you so much for sharing. Really appreciate you guys being so open and honest there. I'm sure we can all relate to some of those things that you just discussed. So why do we need to save? Well, there are four sort of key broad areas that we look at when it comes to saving. First of all, we all have goals and objectives, short, medium, and long term. The reality is we need money to be able to achieve a lot of these things. Secondly, we could put the most amazing financial plan in place for you, but if you don't have that downside protection, that could all fall by the wayside. So you need to make sure you've got the right level of cover for you and your dependents as well. Ask yourself, what would you do if you couldn't work? What would happen to your family? What position would that then put you in? What can you do to make sure that this doesn't put you, and if something else happens to you, it doesn't put you in that negative position? As well as that, we also need to prepare for career breaks, maternity leave, looking after elderly relatives and so on. These are all things that we need to prepare for. And then finally, prepare for increased life expectancy and longer retirements. Not a bad thing, right? It's a good thing, but we need to prepare for it and make sure we've got the funds to be able to achieve the retirement that we want to be able to have. In the UK, men are living to about 79 years. That's the average age life expectancy of a male. For women, good news, we're living longer. It's 84 years old. But we need to make sure that we're preparing for this. But how do we do it? Hands up if you know what goes out your bank account each month.
What goes out?
Expenditure. You've got a few half hands. Are these confident hands that you really know? Okay, good. Okay, I'm impressed. A lot of people don't. And when it comes to saving, it's a balancing act. How much you're spending and how much you're saving as well. And the key thing, if there's one thing that you take away from today, the first step to gaining control of your financial well-being is understanding what goes out of your bank account each month. Who here feels anxious about the current increase in the cost of living, inflation? Yeah, it's scary. The spring statement yesterday, inflation is set to be over 7% this year. It's scary, it's daunting. You're not alone if you feel anxious. But again, you can do things to start taking control of the situation. Start to get a better understanding of what goes out of your bank account each month. And start budgeting. And that will put you in the best position possible to gain control of these uncertain situations that we're facing. Also, what's really important is once you get an idea of your expenditure, what you can then start to do is understand, should I be investing? Is this right for me? Rule of thumb, you want about 3 to 6 months of your monthly expenditure put aside as rainy day funds. What I mean by that is if the boiler broke, or like me the other day, you have an argument with your neighbour, you have to spend a fortune putting a fence up down the shared garden in the middle because you're not friends anymore and you can't share the garden. Story, if you want to hang around afterwards, I'll tell you. Actually don't, it stresses me out. Don't want to talk about it, but it costs a fortune. My rainy day funds are now building them back up. But you need to have about 3 to 6 months of your monthly expenditure put aside. Anything above and beyond that, get your money to work harder for you. That's when you should start looking at things like investing. I'm not going to spend too much time on this page because we all have heard about the gender pay gap. But the important thing to note here is our ability to save is restricted by our ability to earn. It's fact, women are earning less than men. The gender pay gap is real. We have to be aware of this and start managing it to put ourselves in the best position possible to save. But there's other things that the gender pay gap also impacts and influences as well. So for example, some of our goals in life. And one of the big goals for a lot of us is getting on the property ladder. But actually, women are less likely to be eligible for a mortgage than men. I was really shocked to find out the other day, I didn't realise this, but there isn't a single region in the UK where the average rent or the average house is affordable for women on median earnings, whereas every region in the UK is affordable for men, except from London. We don't include London when we're talking about property. But I was very shocked to hear that. So how do we manage this? Start to know your numbers. There's a housing crisis in the UK, but that housing crisis is gendered. We are more impacted by the situation than men are. The average age of a first-time buyer outside of London is increasing. It's now 31, and it's even higher in London. And the average price of the first home is £256,000. And for the deposit on that, maybe £60,000. My advice here to you is don't be scared to go out and seek advice. Talk to a specialist, talk to a mortgage broker, and really start to understand what can you afford, what would you like to purchase, and what do you need to be able to get there. Don't be scared to ask specialists about this. I mentioned before about rainy day funds, and above and beyond rainy day funds, it's really important to start looking at your strategy when it comes to investing. Now, investing, there's two really important things to look at when it comes to investing and looking at your investment strategy. The first thing is compounding. Compound interest is effectively interest on your interest. So, for example, if you have £1,000 and you have 1% interest on that, by the end of the year, you will have gained £10. The next year, you will then get 1% interest on that £1,010. Year after year, you're gaining interest on your interest. So the power of investing early is incredible. And that's where the real sort of power of investing comes in. But also, investing is inherently risky. There are risks associated with investing, and you need to take your individual circumstances into account when investing to make sure that your strategy is aligned to your own goals and objectives. So just a little bit more information on compound interest. Now, I think this graph is really, really powerful. I'm a visual learner, so I'm a little bit biased. But what you can see here is we have the example of Daisy. Now, Daisy starts investing £200 a month at age 25. Her investment grows by age 65 to £300,000, given an interest rate of 5%. We then compare this to Ken, who starts investing at age 45 and puts in double the amount. And his investment has grown to, let's call it, £175,000. That's the power of compound interest. Risk. There are different risks associated with different asset classes. As I mentioned previously, it's really important to understand your own personal attitude to risk. It is a really personal thing that we look at when it comes to investing. Things like cash typically has lower risk, but then also your typically low risk assets, you achieve lower returns. And then higher risk assets such as equities, greater opportunities for greater returns. But what about retirement? Anyone have any idea what their retirement looks like, or what you'd like your retirement to look like? Getting there.
Basically, to live comfortably on a certain amount of money a month. Because I have no job, I don't want to pay rent, so I just want money coming in from somewhere that I'm investing, so I can go on a holiday whenever I want to.
Sounds amazing. Anyone else?
That's also my dream too. I've made my plan.
I've got a strategy in place already, I'm ready to go. Anyone at home, any ideas? What does retirement look like to you? For me, I want to be skiing until I'm 110 with a few pot belly pigs. That's my dream. I know this doesn't really go hand in hand, but it's just something I want us to achieve. Anyone else?
I see myself in Okinawa, Japan. I just don't know how much time it is.
Amazing. Any reason why Japan?
I just love the idea of being like, I think they've got like the oldest living community of like 80-year-olds they music together, hang out together, cook together.
Let's all go. Right, we get the ski, we get the many things from there. Brilliant. Sorry, for someone else?
Oh no, I was just gonna say just a lack of options. So
Yeah.
just the option to do whatever I want to do. So whether that's being in Jamaica for a month and then being in Japan, wherever, just options.
We're all going to be there. Amazing. Fantastic. Thank you for sharing that. So how do we save for retirement? Well, the most efficient way and the most tax efficient way to save for retirement is through your pension. Now, we have an ageing population in the UK and simply the government can't afford our state pensions. So what they do now is they heavily incentivise us to contribute into our pensions. So what they do is we get full tax relief on any pension contributions that we make. So, for example, if you put £80 into your pension and you're a basic rate taxpayer, you're going to get that 20% back. So you get £20 back. If you're a high rate taxpayer and you put £60 into your pension, you're going to get £40 back. If you're an additional rate taxpayer and you pay 45% tax, if you put £55 in, you're going to get £45 back. It's the simplest, the best way to save for retirement is simply through pension contributions because of that tax relief that you'll get. There's no other structure like that in the UK. But the earlier you start, the better. So, in terms of your pension contributions, you have the ability to put in £40,000 or 100% of your salary, whichever is lower. That is your pension allowance. As soon as you start earning more and more money, the government say we're going to start tapering your pension allowance. So when you start earning £240,000 of adjusted income, the government start tapering your pension allowance, and that can go all the way down to £4,000. So it's really important to make the most of your pension allowance whilst you've got it. It's really critical because, as you can see here, if you're able to save into your pension during these saving years, before we start having kids and we start hitting this expenditure bubble where everything starts to get really expensive, it's going to put you in a much better position when you're then looking to retire. But know your numbers. It's really important when we're setting these goals to have something that's achievable, measurable, and realistic. So it's really important to start understanding what you need to save to be able to reach your retirement goals. So as an example, if you want to have quite a basic sort of lifestyle in retirement, nothing too extravagant, eating out once a month, maybe an annual holiday in the UK, roughly you'll need about £10,000 in retirement. And to achieve that, you'll need £170,000 in your pension pot to be able to achieve that. Then looking at the other sort of end of the scale, if you want to have a more luxurious retirement, going to the theatre, going a couple annual holidays abroad, then you need to save a pension pot of £600,000. Don't be scared, don't be daunted by this. This is exactly why it's really important to reach out, do your research, but also don't be scared to ask people for advice. So you can start to really understand what you need to do to be able to achieve the retirement that you want to have. So you can start landing predictable outcomes. As I mentioned earlier, there are several things that impact our ability to be able to save and also our ability to reach our retirement goals as well. So things like maternity leave, the gender pay gap, women leaving work early because of stuff like menopause. I found out the other day 1 million women in the UK are forced to retire early because of female menopause. All of these things impact our retirement and our ability to save into our pensions. So start early. My parents always told me growing up kids are expensive, and they're right. As always, your parents are right, aren't they? And it's true. And it's important to know that kids are expensive and they have an impact on your financial position, but that shouldn't hinder your other goals and objectives when it comes to your finances. For example, when you take maternity leave, this can actually reduce your pension pot by £25,000 or over £25,000. But again, that's by starting early and gaining control of these situations is really critical, really important. And it's not all doom and gloom when it comes to kids and finances. We can actually give our kids a kickstart in life. We can actually invest tax efficiently for our children. There are things called junior ISAs. You have the ability to put £9,000 into a junior ISA every year. And that investment grows free of capital gains tax, and you can take tax-free income at any point from that investment as well. We spoke about compound interest earlier. Imagine if you start investing for your little one when they're this big, imagine when they're taller than you, how much that investment could grow just with compound interest alone. And I'm going to pass over to Vas to talk to you guys about protection.
Thank you, Joe. Now, turn this on. Can you hear me okay?
Yeah.
Yes, excellent. Now, Daisy and Ken, in the earlier example on the graph, remember Daisy and Ken? So they are now married, and they have a child, they have a daughter. So they have a pension plan, they have a retirement plan, they have that life planned out ahead of them. What happens when things don't go to plan? Divorce happens. 1 in 4 marriages end up in divorce in terms of people over 50, right? But then what happens if one of us gets ill? Or one of us passes away? What happens then? So I am both a mortgage and protection advisor. And having those conversations every day are not the most comfortable conversation. Right? Who wants to talk about passing away and illness? Could you all do me a favor? Could you cross your arms? Yeah? Everyone at home, I see you. Crossing your arms. Now cross your arms the other way. How do you find it?
I had to work it out first.
Not as comfortable. That's how I feel each day, every day, when I go and have those conversations about early passing or sickness with people. So what gives me the fuel? What gives me the fuel to do that? I could speak to clients about mortgages, couldn't I? Because at the end of the day, nothing might happen. We might come to our 90s, 80s, 90s, and nothing might happen. Well, I know for sure I used to be one of those people that believe nothing will happen to me. I'd rather buy myself another pair of shoes than take out some insurance. So what makes me get up every morning, have that uncomfortable feeling before I go into my meetings with the people I'll be seeing that day? It is the fact that it did happen to me. When I thought that nothing could ever happen to me, it did happen to me. One day my partner was here, the next day he wasn't. And whilst nothing can prepare us, or anyone who lost a loved one, we will know that nothing can prepare us for the feelings that we will be feeling when someone passes away. For 6 months after that, I think I didn't even speak to my friends. I was caving, if that's a word. But the bills didn't stop coming. They kept on piling up and piling up. So once I dusted myself off, I thought, what is it that I can do that's actually meaningful? What is it that I can do that actually can have an impact on people's life, even when it's uncomfortable, the conversations are uncomfortable. So, if we take the earlier example of Daisy and Ken, and I see couples like Daisy and Ken every day. So the main question I ask, the first question I ask is, what concerns you, Daisy? What is it that concerns you? And usually, the majority of time, it's the same concern. I have a child, and I would want Ken to be able to pay off the mortgage and to pay for the education fees if I was to pass away. And whilst that's a valid concern, that is a valid concern, because we all know none of us gets out of life alive. We will always address that concern. But is that the most likely thing to happen to us? When we look at Daisy and Ken, we know that the most claimed against event is not loss of life for someone that age. In their mid-30s, they have a young child. The most claimed against event is sickness, not being able to work due to sickness. Now, Daisy and Ken surely have some sick pay from work, don't they? How long do they have sick pay from work? Let's give 3 months, 6 months? 6 months. Ooh, that's a very good employer. So 6 months, if they are off sick with any sickness, their employer will pay them their full pay. What happens after? Maybe they have some savings. They surely have some savings they can rely on.
No, well, it should be 3 to 6 months.
3 to 6 months? So they'd be okay for another 3 to 6 months to live off their savings. What happens after? The bills stop. No. What if they knew what happens after? What if they had a policy in place? In event of sickness, they know after their sick pay from work finishes, after their savings are finishing, they would still be able to pay their bills. And that's what income protection does. It protects our income in event of sickness. Now, the sickness could be any sickness. How long would it protect us for? It would protect us every single month until the end of our working life, until our retirement age. If, God forbid, we are diagnosed with an illness that doesn't enable us to work for the rest of our working life. What if Daisy gets diagnosed with a critical illness and there is some treatment on the other side of the world that could save her life, and she needs a lump sum, a bigger lump sum, to pay off for that treatment that could save her life? What happens then? Surely she could take out a loan, but they maxed out their credit score and it's not looking good. What if they knew that there is a policy in place that pays up at the diagnosis of a critical illness like cancer, heart attack, or stroke, blindness, disability? What if they knew that policy is in place and the diagnosis of that illness, they would be paid that lump sum and they could be paying for that treatment at the other side of the world to save their life? That's what critical illness cover does. And that is the second most claimed against policy. The least claimed against policy, for someone like Daisy, 4% chances of death happening in between her age and her retirement age. So chances are low, but none of us get out of life alive. So what do Daisy want to do in event of her passing away? She'd want to pay off her mortgage, so she gives some money to Ken to pay off the mortgage in event of her passing. She potentially might want to pay some education fees, but after her passing, if the mortgage is paid off, do the bills still remain? Council tax, yeah, food, going to school, from school to work, from work. What if she knew that there is a policy in place that she set up to pay off every month the bills for her family in event of her passing? And that type of protection is the life insurance policy that's called family income benefit. And that's exactly what it does. It pays off an income every month to the surviving spouse in event of passing away.
For how long?
For Good question. How long does Daisy want to have the payment for? She can have the payment until her youngest child is 21, because it's assumed that that's when they will be out of full-time education. Or she could have the payment paid up to Ken until what would have been her retirement age, because after the retirement age, you start draw out of the pension. Does she trust Ken? Do we trust Ken? 1 in 4 marriages end up in divorce after age of 50.
He's probably going to get married again.
Now, the life insurance policy on the matter of trust, trusting Ken, the life insurance policy can be put into trust, meaning that a flexible trust that can be changed. You can change the beneficiary of a life insurance policy, right? So while it's all good and well in between them now, later on in life, if things don't go to plan, they could go back with a flexible trust and change the beneficiary of the policy as being her daughter. Financially empowered women. Now, all of these different types of protection are both relevant for Daisy and Ken. But we need it more. Women need it more. Why is that? We face health issues that men might not face as much. Because I found out the other day there is such thing as male menopause. Shame on me, I did not know. But female menopause is the one that gets 90% of women to have a negative effect on their work. 32% of women have thought about leaving work altogether or reducing their working hours because of menopause symptoms. So that's something that's more specifically to women. Now we have the carers, the nurturers. We want to look after out for our mothers, for our grandmothers, but when the time comes for us to be grandparents, we as women are the one that might give up work altogether to go and look after our loved ones. But if we don't work, we don't earn. If we don't earn, can we contribute towards our pension fund? So financial planning, we need it more. Now we also live longer. Joe told you, good news, we do live longer. But what that means for us, it's also that we are more likely to spend more time in care. So we would need, in our later years, better financial planning. Now, ensuring that your wishes are fulfilled can be done in a few different ways. So while we are young and healthy and we can look after our finances, as financially empowered women, as Daisy is, she's asking the question, what happens if I become incapacitated and I cannot look after my finances? I cannot look after the direct debits that comes out of my account or my savings account. What happens then? Good question, Daisy. Well, you could leave in place a lasting power of attorney that says that in event of being incapacitated, then the person you wish to look after finances would look after your finances. The person that you know has got your best interest at heart would look after your finances. And that can be easily done for lasting power of attorney. Now, we know that Daisy has left her house now to her daughter. And Daisy's house, she lives in central London. She's got a big mansion. How much is Daisy's house worth?
10 million.
Oh, 10 million. Okay, let's go. Daisy has had a very successful life. So Daisy's house is definitely worth more than the threshold for inheritance tax. So when we pass away, the value of our assets, if they exceed a certain threshold, then the person who we left that asset too, has to pick up with the inheritance bill. Anyone knows what the inheritance bill percentage is? What do we need to? Well done. Everyone give her a hand. Yes. 40%. 40%. So the thresholds are £325,000 for a single person, and £175,000 on top of that if you are a homeowner. So now we know that the threshold over which Daisy's daughter would have to pay 40% of is anything she leaves behind over £500,000. Her daughter would need to pay 40%. So that's a lot of money on 10 million, right?
I don't want a 10 million from
So what happens if we don't pay off the inheritance bill?
Take it.
So what can they do if Daisy's daughter, let's give her a name. What's her name? What's Daisy's
That was
daughter's
the name though.
Gifted. So Gifted, now she lives in her mom's house. What happens when we don't pay off the inheritance bill is that you can sell the asset to pay off the inheritance bill. But then she won't live in the house anymore. So Daisy, when she comes to speak to me, she's concerned. I want my daughter to live in my 10 million house, wouldn't, right? 10 million pounds house. And she asks me, I don't know, what is going to happen? What if she knew? What if she put in place a life insurance policy that is designed, it's called a whole of life insurance policy, that could be designed to pay off an inheritance tax bill. So not only that she leaves her assets to her daughter, but her daughter, because she has got now that provision to pay off the inheritance tax bill, she can stay in the house that Daisy has worked so hard to purchase in her how many years of life? Many years of life. Now, Daisy also wants to make an impact to the world. She cares about the world she leaves behind, because we as women, we care. We, the carers, the nurturers, the lovers. We care about the world we leave behind for our kids, for our grandchildren, for our friends, for our family. Well, she can do that. Do you see how many, all the percentages are over 50%. Percentages of women who care about having a social impact. Now, we hear a lot about how can we have a social climate change, how can we reduce our carbon footprint, and we hear about the fact that if we take the train to work instead of driving, we could save up some carbon there. If we eat just one piece of meat, that could reduce that carbon dioxide. And shortening our shower, I think I've heard this a few times, have you? Yes. Shortening our shower time by only a couple of minutes can help too. I haven't often heard about making your pensions and contributing in your pension towards funds that are sustainable is actually 27 times more effective. Have you heard about that? Have you? We all learned something new today. So yes, we as financially empowered women, as Daisy is, we are in control of our finances throughout the length of our life. And now, we know the gender pay gap is real. We know there are challenges, health challenges that women face that are a little bit different than men. But we also have amazing men right there with us in our corner, being aware of the gender pay gap and wanting to raise awareness and battle our corner. One of them is right there. Everyone give him a hand. Mr. Will Schofield. Yes. Then we have Sam in the house. He helped put together this presentation. Yes. And Carl is one of our leaders. And thank you so much, Carl, if you're out there. Thank you. Because through all of our ups and downs and doubts, he's been there saying, we're doing this. Every single week we will catch up and we will make this happen. So thank you so much for coming here this evening. But this evening wouldn't have been possible without a very special lady, and that's not me, because I want to change the world. I always have these big dreams about change the world. Some people might know me, yeah. You would know that I want to change the world, but I'm always scared of getting started, of maybe I'm not good enough, maybe I'm not going to come across well enough, and so forth. So it takes a very special type of person to say, we're doing it, how exciting, oh, is it challenging, how exciting, I can't wait to pass on my knowledge and empower women financially with everything I know. And that amazing woman is Joyce Dean. Yay! Over to you. Thank you.
Your impression of me is so good. And that, your impression of me is way too good. How excited. Thank you everyone so much for being here tonight. Any questions? Silence.
Oh, anyone back?
Anyone back home? Put it in the chat. Yes.
Is whole life insurance the same as a term life insurance?
No. Term life insurance finishes. That's why it's called term, right? So term life insurance is something like, I want to take out life insurance until I'm 65. That's term. Whole of life insurance is no matter when death happens, that insurance will pay. And that can be done with a financial advisor. So definitely easy enough to do. Any other questions? Yes.
Where would you recommend saving now or investing with the inflation spike?
It's really tailored to your individual situation. So my main sort of advice to you is actually sit down with advisors and speak about it, because you just need to start having that conversation. It's so personal. For example, you might be really interested in sustainable investing, for example, and that's really personal. It could be that because of your religion, you actually want to invest in certain funds as well. So it's really depends on so many different factors. Also, we spoke about risk earlier. If you've got a low attitude to risk, then actually you need to make sure that you're investing in something that's low risk versus somebody that's happy to take on a bit more risk, but then you might see drops of 20-30% in the fund. You need to start to work out actually what do you feel comfortable doing, and that's where really having those conversations with a specialist will really benefit you. Anna.
If you're saving for children, where do you start?
Very good question. I guess it depends on what your surplus looks like. So it's really expensive when we start to have young families. And as I mentioned before, probably the place to start, often when you have a child, especially your first child, it's about building up those cash savings again so that you've got those rainy day funds. But then above and beyond that, if your priority is to save for your child, then definitely look at things like the junior ISA. It's a really effective way to be able to give them a kickstart in life.
Does it only have to be your child? I mean, what if you have no child and you've got nephew and nieces?
Yeah, so there's a few different things that you can look at. So actually, it might be in that situation you want to start utilising something like an ISA. And actually, an ISA works in a really similar way to a junior ISA, but with an ISA, you've got the ability to put £20,000 a year into an ISA. It grows free of capital gains tax, and you have the ability to take tax-free income from that at any point. And then you could utilise that in whatever way you want to. You could use that yourself, you could use it for family members, you've got that flexibility there, and it's fully liquid as well. So you can take from that investment at any point.
With regards to sustainable fund that you mentioned earlier, do you get to choose which companies you invest in, or do you guys do that on behalf of clients?
Yeah, so it depends where you're looking to invest. But with St James's Place, when you sit down and talk to an advisor, they'll actually look at the portfolio with you, and together you can look at that, see the different funds, see what you're investing in, and get a real idea of actually where your money is being invested. So it's definitely something you can sit down and look at with an advisor, and that's the same across the board, whether it's with St James's Place or with somebody else as well. I'd encourage you to do that. Any other questions? Yes.
With the life insurance policy, I presume St James would take a cut from that. How do you guys take that cut?
Yes. So depends very much on how many advisors speak to you, right? So St. James's Place always takes a generic cut, and then we take the depending on how many advisors are involved in it. But as part of the conversations you have with your advisor, at every single point before you take the decision of taking out any sort of life insurance, that would be disclosed to you. So you would be sent an illustration, and on illustrations, it's not going to only say what is it that you're taking out, the terms and conditions, the small print, that what's not covered. But it's also going to say on the bottom of the illustration what commission is there for the advisor. So it's very personal to you.
And is it usually flat or scale based, or is it percentages?
Depends on what company you're taking it out with, right? So St. James's Place, for example, they might take 33%, but then the company they are working with as partnership might take a cut as well. But you will know as soon as you speak to your advisor about insurance, you would know exactly what the commissions on that policies are.
And are they pre-tax or does it come out of your? Sorry, I had a policy before, it came straight out of my income first, and it was tax-free.
So you mean the proceeds of the life insurance? Or like the proceeds
percentage of my income went to the insurance policy. I think it was through the pension.
Oh, on the pension.
I'm not sure to be honest, but it's something we can definitely go away and have a look at, and if you want to connect afterwards, we can pick up on that. There are situations, for example, like if you're a director of a limited company, you can actually treat protection as a business expense. That's how similar to what you're talking about there. Would you like to share? I'm going to pick on people now. Very much so. But definitely we could pick up after that and look into that in a little bit more detail. But there are situations where you can treat protection as a business expense, and that can be really beneficial. Any other questions? Yeah?
I know you haven't mentioned this, I'm not sure whether this is the space for it, as in the cryptocurrencies and the NFTs. That's probably an area that I don't even know that much about. So is that something that you guys cover, or is that a different company altogether?
So what specifically about things like cryptocurrencies?
It's just understanding NFTs, whether that's a good investment. When you mentioned about risk, one that was on the board probably might be quite aware of them. But in terms of this new, Bitcoin and all that kind of stuff,
Yeah.
where does that fit within the company?
Yeah, really great question. So we get asked this quite a lot. I think I hear Bitcoin probably a couple times a day. But it's because it's so important right now. It's a really, it's a really sort of, over the last couple of years, the amount that it's grown, the interest behind it, it's really important to look at when you talk about investments. And actually, from St. James's Place position, it's something that, like many sort of market, is evolving all the time. And at this moment in time, our funds don't include cryptocurrencies, but it's definitely something that we're talking about in the background, and in the future, who knows. I don't really know at this moment in time what that looks like, but I know discussions being had in terms of what do the next 5-10 years look like. Like any company, we are looking ahead to see what that could potentially look like, but nothing's set in stone at this moment in time.
John?
So with pensions, so when you invest your pension, this is about how much risk you take, right? And then depending on that risk, what you invest. With the pension, clear to understand, if you're investing, say, 20,000 a year, over 20 years, you expect it to grow, not be less, right? Because of the risk you take. But there's no guarantee on these things, right? So that's where the risk appetite comes from.
Absolutely.
So we should really look at things that we're investing in every year and see if we're happy or not happy with that, right?
Yeah, absolutely. So when you have a relationship with an advisor, ideally you need to be sitting down with them at least semi-annually, if not more regularly. That's really down to you and your advisor to manage that relationship together and have that really honest two-way conversation about, okay, how is this relationship going to work? Some people want to see me once a year and that's enough for them. They're very happy letting it tick along in the background, just get an update every now and again. Some people, it's regular phone calls every couple of months or every month or so. It's really sort of down to your personal preference. With your pension, as you said, it could go up, it could go down. there's no crystal ball, that's just the nature of investing. So that's why sitting down, rebalancing or re-strategize when and where appropriate with your advisor is really important.
That's why you need to have a mix of a portfolio then. Because my expectation would be I want my at least pension to be constant, not go down, right? But that's not the guarantee.
No
So
guarantee.
yeah, so okay, I need to rethink.
Yeah, so diversification is really important. It's actually when you're looking at sort of the ideal portfolio, it's not just about pension, but it's also building up other investments as well. So things like the ISA, things like unit trusts and so on. It depends on your individual circumstance, but ideally, it's good to have a diversified portfolio so that when you come into retirement, you're not just relying on one investment. You've got the ability to take these different pots that you've built up. And again, it's a really good point that you said about risk. Actually, when you start to reach retirement, it's appropriate to start de-risking for most people as you're reaching retirement. Take on less risk. And again, sitting down with an advisor and rebalancing during that point is a really important process to go through.
In Australia, there's a way that you can, I don't know how, but a way you can make property as part of your superannuation. Is there a way you can get property into your your pension here? Does that work?
Yeah, so there's a few different things around sort of commercial property and pensions. It's quite a convoluted area, to be honest, and it's not something I particularly specialise in. But again, I can go away and find out a little bit more information that's a particular area that you're interested in. It isn't standard for a typical sort of pension in the UK. But please do connect afterwards if you want to find out more about this. Any more questions?
I was going to ask, I don't remember if it's yourself or Van that had mentioned it's important that you have 6 months worth of your savings and then after that to look at the rest in terms of like investing, what you do with it. But I would assume that wasn't enough. So is that with the mindset that you have your insurances and everything comes covered?
Yeah, pretty much. So it's because I guess the key reason for that is to do with inflation. So if you have too much cash sat in the bank, the value of your cash and the sort of purchasing power of your cash is going to erode because cash, especially given current interest rates, isn't going to keep pace with current inflation rates. So that's why actually about 3 to 6 months of your monthly expenditure is an appropriate amount. And then if you've got the protection in place as well, that will give you the right level of cover. And then anything above and beyond that, get your money working hard for you.
But is there a way to ensure that? Because I'm on the scale of, are you, there was like, what's your approach on investing? Are you willing to take the risk? I am not willing to take the risk.
Yeah.
So for myself, how would you look at investing in a safe way? So you're almost guaranteed that return. So,
Yeah. So you can never guarantee the return, but I think for somebody that's more risk averse like yourself, and you're not alone in that, many individuals, especially females actually, a lot of females tend to be more risk averse. Maybe having slightly more rainy day funds is appropriate for you. So instead of 3 months of expenditure, look at about 6 months. Wouldn't recommend that one. But maybe at the higher end, so 6 months. And then when it comes to investing, look at a low risk strategy. And when we talk about low risk strategy, you're still looking to take enough risk to hopefully beat inflation, but maybe you're not going to see as much growth as a higher risk strategy. But the aim there is to keep pace with inflation so that you're not losing the value of your cash. That's the sort of aim there when you're looking at lower sort of risk strategies.
Definitely, I would totally agree. So is the risk of keeping £1,000 in my bank account, next year I'll have 2% less if the inflation goes up, and the year after I'll have 2% less of my second year, right? So is the risk of that versus the risk of taking an investment? There are low risk strategies out there, nevertheless a risk.
Like property, if you invest in property, depending on where it is, the value goes up.
Yeah.
So the equity probably goes up with that. So that's probably, but still, if inflation comes in and you sell it.
So it's a really good point. So
I don't know.
with different asset classes, so with property, for example, there's certain risks associated with property. So things like liquidity, are you going to be able to sell it?
Yeah.
And who knows what's going to happen with property prices. Also, interest rates directly impact your ability to borrow.
Yeah.
which then impacts your ability to then purchase houses and property. So all of these different things, all these different asset classes have different risks associated, and that's where diversification comes in. You mitigate the risk by spreading your investments across different asset classes.
Then your personal income needs to be good then,
Yeah.
Get paid more.
Yeah, and then you can add more.
Base pay, not just bonuses on top.
So at the risk of not having too many options for people who are risk averse, do you tend to then advise them to go for like bonds and shares and things like that, and not necessarily talk about the more high risk investment?
Yeah, so if somebody tends to be more risk averse, then a sort of typical strategies of looking at lower risk assets like bonds, and then balancing that with equities to also, again, have that opportunity for a bit of growth as well. It really is dependent on how risk averse you are. But yeah, bonds are a great example of a way to sort of de-risk a portfolio.
But the emergency fund, they say 3 to 6 months, you don't want to leave in an investment because you need to have access to that cash quickly.
Absolutely.
How do you beat inflation if it's going to be 10%? You're going to lose so much money if you leave that emergency fund. It's sitting somewhere, right?
Yeah, I think you answered your question there in terms of it's just about having that easy access, and the reality of life is things happen sometimes, like the boiler breaking or having an argument with a neighbour. These things happen, and so it needs to be there, easy access. There are certain investments that are liquid, like the ISA. You can take income from the ISA at any point, but ideally, if you're investing, it's really for the longer term. And well, yeah, that's so with cash, for example, the interest rate isn't going to beat inflation, but it's just that trade-off. But then with cash, it's lower risk investment. So it's different trade-offs for different assets. So it depends on what you're looking to achieve. And with cash savings, it's very much about having liquidity. That's sort of the key benefit of cash savings. So it's that balancing act again.
In terms of like, so if you were a trustee for your children, for example, how easy or how difficult is it to transfer? So when they get to a certain age, I guess it's 18 or whatever, they take over their own portfolios. You're actually saving and investing on their behalf up until 18. Is that something that you guys offer as well?
Yeah, so trust planning is a really big part of what we do. Legacy planning, trust planning, and there's lots of different ways that you can do that. So things like absolute trust, discretionary trust, and you can really tailor that to what you're specifically looking to do. It is quite a complex area when it comes to trust and legacy planning, but it's something that we actually specialise in at St. Space.
I should have asked the right questions before. I think like when I was 20, I didn't know anything. So I've lost like how much I could have built up on pension in 20 years working with companies. But I didn't think I invested properly because I never understood it correctly. But you need to take time to understand it. I need to dumb it down for me because it goes over my head.
But you're not alone. That's how majority of people feel. And that's not, that's not on you, that you said you just sat down and looked at it, but did you have the tools and resources there to find that information? Was it easily accessible for you? I would argue not, probably. My experience is these things haven't been easy to go and find out, and it's really complex.
Yeah, and how they communicate it, right?
Yeah.
So they think they're communicating it right, but no. But then I should have asked as well. So it's a two-way relationship.
Yeah,
Will's going to get lots of questions from me next.
absolutely.
And then you can pass it on to the younger women in your workplace as well.
Yeah, exactly.
Children or not.
Yeah.
Absolutely, and that's really what today is about. It's just about starting to change the narrative, start to talk about these things. And as I said to quite a lot of you at the beginning, this is just the start of many more events to come. We were really excited about tonight because it's been such a strange time with the pandemic, not being able to do face-to-face events, and we really want to keep this conversation going. So please do keep coming, keep getting involved, and bring colleagues, bring friends. It's really amazing to see all of you in the room today and those at home as well. Any other questions before we close?
When's the next event?
Soon. ASAP, Rocky, absolutely.
That's really helpful. Very
Brilliant.
Yeah.
Thank you so much.
Thank you for
everyone.
being here.
Thank you.